Short-term finance provides businesses with funds to support working capital requirements, manage cash flow fluctuations, and finance day-to-day operations. Unlike long-term financing, which is typically used to acquire non-current assets or support strategic expansion, short-term finance is generally repayable within 1 year. Organizations use various sources of short-term finance depending on their liquidity needs, cost considerations, and operational circumstances. Among the most important sources are short-term loans and debt factoring. Both provide access to cash within a relatively short period, but they differ significantly in terms of structure, repayment obligations, cost, and impact on business operations and financial management. Short-term loans are funds borrowed from financial institutions or other lenders for a specified period, usually less than 1 year. These loans provide businesses with an immediate source of cash that can be used for working capital, seasonal financing needs, inventory purchases, or temporary liquidity shortages. The loan agreement normally specifies the amount borrowed, the repayment schedule, the interest rate, and any security requirements. Because the funds are received in a lump sum, short-term loans offer certainty regarding the amount of financing available and enable businesses to address immediate financial needs effectively. One of the key advantages of short-term loans is predictability. Borrowers know the amount of finance available, the repayment obligations, and the associated financing costs from the outset. This facilitates budgeting and cash flow planning. In addition, short-term loans can often be arranged relatively quickly compared with long-term financing. However, they also create a contractual obligation to repay both principal and interest regardless of business performance. Failure to meet repayment commitments may damage creditworthiness and lead to additional costs. Consequently, businesses must ensure that sufficient future cash flows exist before relying heavily on short-term borrowing. Debt factoring represents a different form of short-term finance because it is based on the sale of trade receivables rather than direct borrowing. Under a factoring arrangement, a business sells its accounts receivable to a specialist finance company known as a factor. The factor advances a substantial proportion of the receivable value immediately and subsequently collects payment directly from customers. Once collection occurs, the remaining balance is paid to the business after deducting fees and charges. Factoring therefore converts outstanding credit sales into immediate cash and helps improve liquidity without creating traditional loan obligations. The primary advantage of debt factoring is the acceleration of cash inflows. Businesses can obtain funds without waiting for customers to settle invoices, thereby improving working capital management and reducing pressure on cash resources. Factoring may also reduce administrative burdens because the factor often assumes responsibility for credit control and debt collection activities. However, factoring can be relatively expensive due to service fees and financing charges. In addition, customer relationships may be affected if debt collection is handled by an external organization. Businesses must therefore weigh the liquidity benefits against the associated costs and operational implications. In summary, short-term loans and debt factoring are important sources of short-term finance that support working capital and liquidity management. Short-term loans provide borrowed funds that must be repaid with interest according to agreed terms, offering certainty but creating fixed repayment obligations. Debt factoring generates cash by selling receivables to a finance provider, improving liquidity and potentially reducing administrative responsibilities. While short-term loans are based on borrowing, factoring is based on converting existing assets into cash. Understanding the characteristics, benefits, costs, and risks of both financing methods enables management accountants to select appropriate funding solutions and maintain effective financial management.